Hello everyone. Today I want to go over what risk management practices a professional trader implements. If you've been trading for months or even years and still feel inconsistent, anxious in trades, or stuck around break even, it's probably not your strategy. Most traders think profitability comes from finding a better entry model. It doesn't. It comes from how you manage risk, how you manage trades, and how you manage yourself. I've seen traders with strong models fail because they size too heavy, move stops, break rules, or take trades outside their plan. Meanwhile, traders with simple systems stay consistent because they understand one thing: their job is to manage risk. Today, I'm going to walk through what that actually means. Before we even talk about risk, you need to have an edge. An edge is a repeatable process that has positive expectancy over time. That could be a structured model, a system, a framework you've studied, back-tested, and forward-tested. For me, I trade ICT-based concepts, so a structured model would look like the 2022 model, turtle soup concepts, or the AMD, accumulation, manipulation, distribution model. But the specific strategy doesn't matter for this discussion. I can discuss my strategy and how I trade in another video. What matters is that you know it works. You've studied it, you've tested it, you've seen it play out enough times to trust it. And without that foundation, risk management becomes random because there's nothing statistical underneath it. Most traders think risk management starts after entry. It starts before the session even begins. You need defined rules around when you will trade, how many trades you will take, how much capital you're willing to risk for the given trade, what conditions must be present. Personally, I risk 1% or less per trade. That keeps me conservative and removes all emotional pressure. Before I trade, I journal the directional bias, my emotional state, my intention for the session, how I'm feeling, what my energy levels are, and this creates awareness. When I enter a trade, I journal why I entered, whether the setup followed my rules, where my stop loss and targets are, and I rate my execution out of 10. Over time, this builds data, and usually what you discover is that your biggest problems are not strategy problems. They're psychological leaks. Impatience, overtrading, forcing trades, and breaking structure. By journaling, you're able to see the areas that you're lacking in, fix your weaknesses, and make improvements. Once you have an edge and defined rules, the next step is simple. Every trade must have a predefined stop loss. So if I enter off an inefficiency or a PD array, let's say a fair value gap, my stop would go below the low of that fair value gap. If I anticipate a more volatile environment, such as a seek and destroy session, I may place the stop at the open of the candle that makes up the fair value gap. This gives price more room to work with. What I do not do, however, is move my stop further once it's been placed. Risk is defined before the entry, and it cannot be negotiated afterwards. If you find yourself adjusting stops to avoid taking a loss, you're not managing risk. You're avoiding accountability. Now, of course, this does not mean that you don't trail stop and profit. That is actually a great way to manage your risk and trade, and should be done by all traders, in my opinion. We'll get more into that later in the video. On every trade, I structure it the same way. I take a fixed 3R partial. Once price reaches 3R, I move my stop to break even. That locks in profits and removes any downside. This 3R fixed partial works well for me because I usually anticipate pools of liquidity that are greater than 3R. This does not mean that you also need to take a plus 3R target. For you, it could be 1R or 2R or half an R. Figure out what's best for you, your personality, and your strategy. Additionally, if I'm targeting something that's less than 3R away, which is very rare, then I adjust the partial to be 50% of the move between my entry and the target. The idea is simple: secure profits, remove risk, and let the rest play out. If price shows behavior that reduces my conviction, such as the unwillingness to move, or structural shifts, or resistance from higher time frame PD arrays, I either reduce size or close the trade entirely. Trade management is supposed to be dynamic. Your risk is fixed, however, once you enter it does not mean that you have to glue yourself to the idea of it. If the price action presents evidence that it is unwilling to move as you anticipated, manage your trade accordingly. There is nothing wrong with reducing size or exiting the trade entirely in such scenarios. One of the biggest reasons traders feel anxiety, fear, or impulse in trades is size. They size too heavy, and when price moves in their favor, it reinforces their bad behavior. When price moves against them, it triggers more emotion. That emotional cycle leads to revenge trading, doubling down, and irrational decisions. As a professional trader, you are in the game of probability. You're executing a model over a series of outcomes, and if your size is appropriate relative to your account, a single loss should not affect you. If your size is too large, every tick will feel personal, you're going to get anxious, your heart rate will increase, and you will not be making rational decisions. As a professional, you have to focus on longevity and compounding. Rules mean nothing if you cannot stick to them when you're under pressure. If you say you'll take one trade in that session, take one trade. I limit myself to one trade a day. I have very rarely deviated from that rule for myself. If I miss a setup, that's fine. If I lose, that's also fine. The market will offer another opportunity tomorrow, next week, next month. Opportunities are infinite. Capital is not infinite. If it was infinite, I personally would not be trading. You have to operate from that mindset. I also define exactly when I trade. For me, that's during specific macro times within major kill zones, which ICT teaches is when price is likely to seek liquidity and when high probability setups form. This is between 9:50 and 10:10 a.m. usually, whenever I trade the New York AM session. If I trade another session, it's still within a macro. There's no random engagement. I don't take any trades out of boredom. I don't force any setups. I act with precision, and this allows me to be consistent over time. Time comes before what price action is doing for me. Again, as a professional trader, your job is to simply manage risk. This means proper sizing, taking partials, securing profits, trailing your stop, journaling your emotional state, your executions, defining trade frequency, defining trading windows. This is the framework that keeps your edge intact. Without these things, even if you had the best strategy in the world, quote unquote, it would still be highly improbable for you as a trader to succeed. Your job is to protect capital, execute the model, and repeat this over and over again. I hope y'all were able to take away something from the video. I appreciate you taking the time to watch. If you'd like to see my executions and how I trade, please visit my channel. I post recordings of every execution I take, how I go about it, how I manage the trade. You can see how I manage my risk. Please like, subscribe, follow for more.